Hello, good morning. You're watching Market Cafe on ET now with me, Vinny Motiwala, along with me is Ankita Saxena as well. Ankita, very good morning to you as well. And markets, at least the handover from the US markets, continues to be a bit dull and subdued.
Absolutely. Good morning to you, Vinny, and good morning to everyone. Like you mentioned, the handover is pretty dull. It's lackluster, pretty flattish and pretty directionless as well. I mean, yesterday the S&P 500 finished little changed, as earnings season is in full swing now, and investors are, they are going through the latest results from the companies, including Netflix and Morgan Stanley that came out yesterday. Netflix shares fell 3.2% despite beating the analysts' expectations on earnings per share. Now, the company also added more subscribers than it was expected, but it fell short in the revenue estimates, and hence the shares fell 3.2% in trade. Now, earnings from the major banks and institutions are wrapped up, with Morgan Stanley gaining up 0.7% in trade. Despite strong results for Morgan Stanley, the stock initially traded down as margins were weaker than expected. So these were the two major results that came out in the US markets. Let's look at the markets now. The S&P 500 inched largely flat in the red, 0.01% lower, was flat but in the red. The Nasdaq composite eked out 0.03%, again largely flat, but ended the day in the green. The Dow Jones Industrial Average lost 79 points, so mixed but largely flat, no direction there. Now, a lack of forecast from the major companies also left a lot of investors, wondering what the next Federal Reserve's action is going to be with the rate hikes due in a couple of weeks now. 3rd of May is the date. Also, the European markets closed lower yesterday. The European market stocks 600 index closed 0.1% lower. The DAX was up 0.08%, largely flat in the green. CSE was up 0.2% and FTSE was lower 0.1%. So a little bit of a mixed handover coming in there, Vinny.
Absolutely, a mixed handover is what we're getting in and coming in from the US markets. But let's look at some of the important events that we are keeping an eye out on this morning, and obviously all throughout the day as well. So on the global front, let's watch out for the China prime rates. In US initial jobless claims data, that's an important one we're keeping an eye out on, and obviously it's the weekly expiry as well in the domestic market, so maybe volatility could continue a bit in the Indian markets as well. And talking about domestic front, we do have a whole host of earnings that will be reported today. On the Nifty, we have HCL Tech from the IT space that will be reporting their numbers. And other than Nifty, let's watch out for Cyient as well as ICICI Prudential Insurance, which will be reporting their numbers as well. Corporate actions, a lot of them happening. TTK Healthcare to consider proposal of voluntary delisting. Then we have Eon Exchange, which will consider a stock split. EID Parry, Moltech, as well as Moltech Packaging, Nestle. All these stocks are going to be in focus as is the last day to actually be eligible for some dividend, as if you want to get the dividend of the company as well. Lakshmi Organics will be mulling raising of fundraising plans via equity or debt. Keep an eye out on that one. And obviously earnings con calls all through the day. Tata Communication will be earnings call. Sterling Wilson Signed, HCL Tech, ICICI Prudential will be having their earnings call all through the day as well. So keep an eye out on all these important events today, Ankita.
All right, Vinny, we will be tracking these events very closely, as you mentioned. Now, moving on to some important macro cues from the US Federal Reserve that released its Beige Book report on economic conditions. According to the report, the overall economic activity remained little changed in the recent weeks. Now, meanwhile, the consumer spending saw a mild downtick, but the overall was flat. Now, on the jobs front, growth moderated, and despite moderation in wages, remained elevated. The consumer prices generally increased due to the elevated demand as well as higher inventory and labor costs.
And staying with some macro news, but moving from US to the UK, inflation for the month of March brought in yet another surprise, remained in the double digits as households continued to grapple soaring food and energy bills. Now, the CPI rose by 10.1% versus economists' estimates of 9.8%. However, important to note that this is a slight dip in terms of from the unexpected 10.4% surge that we saw in the month of February, which is snapping the third consecutive month of a decline since October last year, and a skyrocketing figure of 11.1% that we had seen at that time.
And well, US banking giant Morgan Stanley tops analyst expectations in the first quarter despite a decline in profits. The New York-based bank delivered a 19% decline in the earnings. Revenues also slipped 2% to $14.52 billion. As revenues dipped, expenses climbed 4%, largely by the higher-than-expected compensation costs.
And tech giant IBM has surged on the back of a robust Q1 number. Even the technology and consulting arm delivered a dismal revenue figure. Now, the gross margins for the software and consulting and infrastructure division all widened year-on-year basis. The company guided for a full-year revenue growth of 3 to 5% in constant currency terms.
And multinational automaker Tesla missed the Wall Street expectations in quarter one as price cuts weighed on the margins. A sharp decline in gross margins from 29.1% to 19.3%. Do remember, Tesla cut prices worldwide on its EVs, including the US, where it recently cut prices for the sixth time this year amid rising competition.
And let's talk layoffs, right? Because that's the word that has been doing the rounds in the last couple of months. Now, according to Meta's latest round of job cuts announced in March, the company started laying off employees in technical roles ranging from likes of software engineering, graphics programming, and similar lines as well. Now, the same layoffs did in fact impact the company's product-facing teams as well. And going forward, the company also plans to continue these layoffs in the next month as well.
And well, Mumbai ranks 21st while Delhi comes at 36th spot. Bengaluru, Kolkata and Hyderabad follow. Now, we are talking about cities home to maximum number of millionaires. The top spot has been taken by New York City, followed by Tokyo. Now, this according to a report by Henley and Partners. Now, there are 3 Chinese cities and 3 American cities in the top 10. No surprises there. In India, Bengaluru has become the biggest hotspot, garnering a big jump in the number of millionaires in the past 10 years. Now, what are the factors that really attract millionaires to these cities, or these cities in themselves present opportunities to climb the ladder? And how does the presence of so many millionaires affect the economics and the dynamics of these cities? Well, let's take a look. Here's a lowdown on that.
I would think that, as soon as the rich become richer, the wealth sort of percolates in a way because they want more services, more conveniences, etc. So they probably eat out more or spend more in buying more cars or whatever it is that they are spending in. So I think that it's sort of a chain reaction that as more people become rich, then they can afford to have more sort of help in terms of service. They also spend more in products, goods and services. So I think it results in a multiplier effect.
Economics we love to term as agglomeration economics, where you sort of have clusters within geographically, spatial areas which come up. And then that cluster either, thrives or it actually sputters, it just sort of dies down. Now, in the case of some of the cities that you've pointed out in India, those clusters have thrived. And as a result of the agglomeration, you have a lot of value chains that are sort of developing. The example of Bangalore is quite apparent. Bangalore is an IT cluster. So you have a number of forward linkages and backward linkages emerging in Bangalore, which are creating a cluster of growth there.
Let's move on and talk about India, which is now the world's most populated country according to the latest UN report. Now, that is almost 3 million more than the neighboring country, China. My colleague Vikram Oza is here to decode that what the report actually discusses in terms of growth and where the world population actually stands at. Let's go across and listen in.
So India has surpassed China as the world's most populous nation. You heard that right. A report by the United Nations Population Fund estimates India's population of 142.6 crore to be almost 3 million more than China's. The United States is a distant third with an estimated population of just 340 million. Indonesia and Pakistan follow next on that list. The world population is also headed towards hitting the milestone of 8 billion people on the 15th of November. And together, India and China are going to account for more than 1/3 of this 8 billion plus population. So while Asia and Africa, both these continents are expected to be the key contributors to the next billion, Europe and China's contribution are going to be negative because of declining population. In fact, last year, China's population declined for the first time in 6 decades. And if the UN report holds, China's population is going to further decline, leading to a more aged population than India's. Further, China's working age population has been on a slump since the year 2012. And according to estimates by the United Nations, the Chinese population between the age of 15 and 64 could decline by 60% this century itself. This is, of course, in sharp contrast to India, which is expected to benefit from the demographic advantage of a younger and a more skilled workforce. Despite the high of 8 billion, global population growth seems to be tapering off. While the global population has grown 2.3% annually in 1963, it fell below 1% every year in 2020, which was a first since the 1950s. Rising life expectancies, falling fertility rates, these are some of the biggest contributors to the kind of decline we're seeing in population. Global fertility rate has more than halved over the last 7 decades, and if this slowdown continues, then global population is expected to peak at 10.4 billion in the 2080s and decline thereafter. So while the world may be aging a bit, India is clearly alive, it's young, with the largest youth population across the world. But can the world's most populous country reap this demographic dividend, like we call it, to its advantage? That is something we're watching very closely.
And well, the hottest news right now is the Apple CEO Tim Cook, who met Prime Minister Narendra Modi and who says that India is witnessing a tech-powered transformation. Meanwhile, Tim Cook also met the Deputy IT Minister Rajiv Chandrasekhar, and sources say that Cook also promised more jobs in India in his meeting with the IT Minister Ashwini Vaishnav.
Absolutely, and after Mumbai, New Delhi is set to say hello to Apple. India's second Apple retail store is set to open for public, and that is going to be today, and the public is waiting with bated breath, eager for Tim Cook's arrival and getting the feel of the new store as well. My colleague Sumita Karir is here to give us more details on that. How is the Delhi store looking like? What are we expecting there as well, Sumita?
Well, Apple is finally saying hello to Delhi after Mumbai's BKC store. So this is the first ever retail store of Apple. And as you can see here, there are various products on display here. So you have all the Apple iPhones on display here. You have all the iPads in various shapes and sizes over display here. Again, there are another set of iPads on display here. And I'm also going to take you through some of the MacBooks that are over display here. There are some accessories as far as Apple Music is concerned. Then, of course, we have all of these MagSafe adapters over here. There is Apple Arcade as well, which is, of course, the gaming station. There are some iMacs over here. So all in all, it just looks like a very, very expansive store, although not as big as compared to Mumbai, but really talking about the look and feel of the store, it really is comparable to any other global Apple store if you've ever visited any other Apple global store. And of course, they call it a sustainable. Apple is going big on its sustainability agenda as well. There is a whole lot of localization as well, and not just products, but Apple really leads as far as marketing is concerned. So they are, of course, tapping into the creative fraternity in a way, whether it's via its products and features, for instance, cinematic mode in iPhones for filming. And here also you have creative geniuses to help people, resolve their product-related queries. And there, again, You see some more Apple products, and on that wall you can see all the Apple accessories. There are those Apple covers on display. But one would really wonder what really took Apple so long to come into India. Well, Apple has been trying to come into India, since a couple of years, but then due to FDI rules, it could not happen. It got derailed, and then due to the COVID-19 pandemic, it got derailed, and then finally it's happening. It's been Apple's 25 years in India, and we're all pretty excited.
All right, then I hope, Vinny, Delhi also sees the same kind of praise that Mumbai saw. I mean, of course, it's a big deal that Apple is coming to India after 25 years.
Absolutely, that's very interesting there. But Ankita, on that note, we're going to slip into a very short break, so don't go anywhere. We'll be back with more domestic updates after this break. Welcome back, and you're watching Market Cafe on ET now. Ankita, it's time that we have a look at what the Asian markets are doing and how they've opened up this morning as well. And let's take a quick look at what is Nikkei doing. Nikkei is up by almost 0.10%. Nothing exciting coming in on that front as well. Shanghai, Hang Seng, nothing interesting. Shanghai, while Hang Seng is trading with mild gains of around 0.3% in trade as of now. Kospi 2 has seen actually a decline of 0.5% in trade, so weakness seen on the Kospi front as well. Overall, when you're looking at it, SGX Nifty is indicating quite a muted start for the Indian markets as of now as well. Just up 38 points is what you could say, up almost 0.22%. That's 0.2% in trade. So yes, what SGX Nifty is indicating is nothing exciting for the D Street. It's obviously the weekly expiry as well. We could see some volatility there. Let's keep an eye out on that, because not much of an exciting handover coming in from the US or the Asian markets opening, also not indicating a sharp up move that we could see in the Indian markets. And IT stocks have been a bit jittery in trade post. We saw the numbers coming in from TCS and then Infosys, which led to a lot of fall in the IT stocks. Saurabh Mukherjee of Marcellus Investment Managers believes that the deal activity in the tech space remains strong as wage inflation pressures on the stocks are gone. Let's go across and listen to his view coming in on the IT space.
Situation in TCS's results. Not only are they reporting operating margins of around 25%, actually operating margins 25%. The staff, the input cost pressures there, the wage inflation pressures that we were seeing last year are gone. You're seeing YOY top line and bottom line, YOY and local currency doing around 15-16%. But most importantly, you're doing, I think, around $10 billion of deal wins. And more generally, if I look across the IT services industry, the deal wins number, deal activity is actually quite solid. What these companies are rightfully doing is they're telling you that, look, 4 banks have gone bust in the Western world in the last month. And naturally, therefore, Western CEOs are circumspect about what they're going to do in the next couple of years. And these are high quality, honest companies. I think TCS and I also reckon Infosys has similar sort of DNA. These are high quality, honest companies, and they're tempering down expectations of the future. You and I all just have to use our common sense and if we expect Western banks to keep going bust ad infinitum, then obviously life gets difficult for the Indian IT services companies. But I don't think the Western bankruptcy situation for big banks is a permanent situation. Once the Fed starts cooling off rates, the whole mark-to-market around their bond portfolios fades away, and the long-term trajectory that we have seen from TCS, Infosys, I think we get back to that.
Well, it's time for us to slip into a short break, but let's...
Welcome back, and you're watching a Market Cafe on ET now. Let's get more stock specific and talk about one very important stock that's going to be in focus today. That is Tata Motors. Now, Tata Motors owned Jaguar Land Rover announced its $15 billion investment plan to ramp up its business over the next 5 years. The British luxury car maker aims to improve their industrial footprint, vehicle programs, autonomous as well as AI and digital technologies with this investment as well. Let's bring on board Shrishti, who's tracked down more details on this and gotten us with all the update that it's talking about. Shrishti, take it away. What's this update indicating? What does it mean for Tata Motors and JLR?
Well, yes, rightly said that one of the big investments by JLR till date, and after JLR was acquired by Tata, you are seeing such a big announcement coming in probably for the first time, and this time JLR plans to invest around 1.5 lakh crores in Indian rupees. That is actually 15 billion pounds over the next 5 years, and this particular money is on the plans to accelerate their modern luxury electric first future, and they plan to invest that in industrial footprint, expanding their vehicle programs, autonomous AI and digital technologies, as well as investment in people skills as well. So this is one of the big announcements coming in from JLR, as well as if we talk about some of the other highlights in this particular release is that they say that JLR's Halewood plant in UK will become an all-electric manufacturing facility, and going ahead as JLR continues to focus on their electric portfolio, they also say that JLR, in terms of their reimagined strategy, going ahead with that, their next generation medium-size SUV architecture will be pure electric. The pre-orders will open for their first all-electric Range Rover later this year, and going ahead maybe in 2025 they will start the bookings of this particular car. And they also said that the upcoming cars will be more in terms of the range, and they have also given an indicative price. And they on to the financials, given such a big investment coming in from JLR as well as Tata Motors, they continue to remain focused on their future guidance in terms of financials. They plan to be net cash positive position by FY25 and double-digit EBIT to be reached by 2026. So given a fact that such a big investment is coming up, they continue to stick with their financial guidance as well. So definitely a big announcement by JLR. Back to you.
All right, then there are also some brokerages that came out with its note on Tata Motors. Let's quickly take a look at those. We have Macquarie that says that most of the, of course, brokerages are very bullish on Tata Motors. But first, Macquarie says that they've maintained an outperform with a target price of 511 rupees per share. Now, they feel that the annualized capex is now marginally higher. They also feel that the annualized the delivery on the capex needs to be monitored, and the EV launches are absolutely in line with the earlier guidance. So that was the note coming in from Macquarie. Let's go across to what BofA has to say. Now, BofA says that they're also maintaining a buy with a target price of 475 rupees per share. Now, they feel that JLR is accelerating the electrification. It is a big positive for the company. They also feel that they can deliver expanded, BS deleveraging over the 5 to 6 coming quarters. Also, they feel that aiding JLR's undervaluation are the margins and the CFC delivery, and they have maintained a buy and absolutely bullish on Tata Motors is also Morgan Stanley that says they are maintaining an overweight with a target price of 513 rupees per share. Now, they feel that JLR's announcement reflects the confidence they have in their business. Also, they feel that the balance sheet is pretty clear. Developing could be reiterating the fact that they are deleveraging to lend credibility to JR's EV future. Also, they see a double-digit FY26 margin guidance and are absolutely bullish on Tata Motors. So those were the brokerages coming in for Tata Motors, Vinny.
Absolutely. I'm just going to quickly mark the flashes that we're seeing on our screens coming in as well. That RBI has called for a meeting with the board of directors of the banks on May 29th. This is according to sources. Now, public sector, private sector, foreign banks are all invited for this meeting. The agenda of this meeting is yet to be circulated to the banks. Meeting is likely to discuss some of the issues related to governance as well as ethics as well. Let's keep an eye out on that one. That's what we are getting reports according to sources as well. But keeping it then with the banks, AU Small Finance Bank said that it has received permission from the Reserve Bank of India to deal with foreign exchange. Now, RBI has granted license to act as the authorized dealer category 1. The permission is subject to some of the compliances which are applicable in terms of the regulation. But my colleague Ankur Mishra is here to give us more details on this report. What does it mean for you, Small Finance Bank as well? Ankur, take it away.
Yes, Reserve Bank of India has granted license for authorized dealer category 1 in foreign exchange for AU Small Finance Bank. Now, this will enable the bank to open entire foreign currency range of products like serving imports, export segment, processing inward and outward remittances, etc. And essentially, it will enable the bank to serve the foreign customers who are there in India, and it will be at par like any other scheduled commercial bank which are offering these kind of products currently. Remember, before that, Reserve Bank of India had granted an extension to MD and CEO Sanjay Agarwal, and after that, now Reserve Bank of India has approved the application for authorized dealer category 1. Any small finance bank which has served more than 2 years can apply and will be eligible for authorized dealer category 1, and this was clarified earlier by Reserve Bank of India. And finally, AU Small Finance Bank has become eligible for it. Remember, the numbers are yet to be disclosed by the bank. As far as the last quarter is concerned, the bank had posted highest ever net profit in the last quarter. We need to wait and see how it can continue the business momentum in this quarter as well.
With that, it's time for us to slip to a short break. Don't go anywhere. After the break, we go more stock specific.
Welcome back, and you're watching Market Cafe on ET. Now, let's quickly go across and listen into Saurabh Mukherjee and his views coming in on GM and Podler in his portfolio. What does he like as a domestic demand? Does he see improvement? Let's listen into his outlook.
Glass line reactors remain full from everything that we are hearing. So we got several of GMM's clients in our portfolio. So we keep talking to GMM's clients, and from everything that we are hearing from Baroda, from Vapi, from Hyderabad, the domestic demand for glass line reactors, these are ceramic reactors within which pharmaceutical products are made. The domestic demand is strong. 55% market share globally for GMM glass line reactors. That part of the business remains strong. Profit compounding driven by the glass line reactor piece, I reckon will remain very healthy. The piece that we're doing more work on is the non-glass line piece. As GMMs become now basically a multinational, I would say half of their profits now come from non-glass line reactors. We think revenue momentum is good there, but we're trying to figure out how much of a dominance, what is the strength of the competitive moat here. But if you ask me what the profit outlook here, I reckon that remains very buoyant, as it has been, to give GMM credit, as it has been for the last 3 years. I think the world is shifting away from China towards making pharma and specialty chemicals in countries like India, and GMM remains a play on that.
Well, with that, it's that time of the show where we go more stock specific, and for that we have Ashesha and Vamakshi in the studio. First up, Ashesha, do tell us what are the stocks that have caught your eye and what we need to keep on our radars.
Hi, good morning. So Mastech will be the first one in focus, and that is because they reported the numbers, and the numbers were much better than what the street was working with. It is reported strong set of numbers after posting 2 to 3 quarters of disappointment. On constant currency terms, revenue has grown by about 5.3% on a quarter-on-quarter basis. 12-month order backlog now stands at about $218 million US, which is an uptick of 6% on a quarter-on-quarter basis. Management is also confident with respect to the medium to long-term growth trajectories. On account of that, keep an eye out on Mastech in today's trading session. Let's also talk about ICICI Securities again on the back of their numbers, where revenue from operations was a mild downtick of about 1% on a year-on-year basis. As far as margins are concerned, they did decline a tad bit. They came in at 62% versus margins of 63% that the company reported same time last year. Ultratech will also be in focus, and this will be on the back of their capacity expansion plans. The company said that they've increased capacity of grinding unit in Bihar to 4.7 million tons per annum with the successful commissioning of additional 2.2 million tons per annum. Total grey cement manufacturing capacity of Ultratech now stands at 129.15 MTPA. So on the back of this expansion that has come in, Ultratech will also be in focus today. Moving on to NBCC then, and this one is in focus on the back of an order win. The company said that they won new orders worth about 208 crores. Apart from this, aluminium stocks will also be in focus, and that is because Alcoa, which is largest US-based aluminium producer, reported its numbers, and the numbers were well on a sequential basis. It has reported a growth and it has kept its guidance unchanged for 2023. So on the back of these results that have come in from Alcoa, aluminium stocks the likes of Vedanta, Hindalco, Nalco will be in focus today.
Okay, Ashesha, thank you so much for the whole list of stocks to watch out for in our trade this morning. But we have Vamakshi in the studio with us as well. And Vamakshi, first let's talk about Bank of Maharashtra. What are the recent reports suggesting? What has happened in this space, and why will this one also be in focus today?
Well, a very good morning to all of you all. Bank of Maharashtra is in focus after Economic Times has reported that the bank is considering raising nearly 1,000 crores of equity via the QIP route. Now, the promoter holding is expected to fall by 3 to 4% from the current 91%. In fact, the MD of the company, A.S. Rajiv, says that the QIP sale is likely in the first quarter of this financial year. That is in Q1 FY24. Now, this QIP was actually planned in Q4 of FY23, but this was deferred due to the market weakness. Apart from that, the bank also came out with a recent announcement that they will be considering capital raising on its in its board meet on April 24th. They will be considering raising nearly 7,500 crores via equity in the financial year 24. Now, apart from Bank of Maharashtra, there are some other banks that also should be on your radar. Now, when we look at the current state of government ownership, the SEBI has mandated public ownership to be at least 25%. Now, banks that adhere to this mandate are Bank of Baroda, Canara Bank, PNB as well as SBI. But there are some banks that are under RBI's prompt corrective action where the promoter holding is over 90%, and such banks include Central Bank of India, IDBI Bank, Indian Overseas Bank, UCO Bank. In fact, 8 out of 12 banks that are state-owned have government holding in excess of nearly 75% at the end of 2022. But as of now, we have Bank of Maharashtra in focus. The board will be considering fundraising on April 24th, and that is the reason why this counter should be on your radar today.
All right then, but hold on there, Vamakshi. You also have all the brokerage notes that came in this morning. Do take us through what the brokerages are saying and what are the stocks that are in focus today?
Well, absolutely. Let's first start off with Container Corp. We have a note that has come in from Goldman Sachs, and they're highlighting that the company could be the key beneficiary of rail containerization. The company already has a dominant market share in India's rail logistics. In fact, they're expecting 15.5% earnings CAGR over FY23 to FY25 with healthy cash generation. The stock is well positioned for outperformance as well, and given all these factors, they've actually upgraded their rating from neutral to buy. They've also hiked their target price to around 720 per share from 670 per share. Apart from that, watch out for AU Small Finance Bank. We have a note that has come in from Morgan Stanley, and they're highlighting that the RBI has granted authorized foreign dealer license to the bank, and this is in fact a very big positive that has come in. They're expecting it to boost the fee income over the medium term, and the benefits are likely to kick in from FY25. AU's long-term growth potential is also quite strong, and in fact, they're expecting to see some strong earnings growth come in for this bank over the next few years. So given all these positive factors, Morgan Stanley has maintained an overweight rating on AU Small Finance Bank, given a target price of 835 per share. And lastly, watch out for steel counters. CLSA has maintained that there is a pickup in China demand, and there is a soft coking coal prices that could in turn drive re-rating for all these steel counters. Cross exports from India are also expected to see a pickup. They see several near-term re-rating catalysts emerging for all these steel counters. Now, out of the entire steel pack, GSPL and Tata Steel are their top picks.
Okay, Vamakshi, thank you so much for all the brokerages that have come in this morning. But let's move on and talk about another stock that is, that we're keeping an eye out on. Actually, aviation space that we're keeping an eye out on is SpiceJet management actually met with some of the analysts. There's Jeffries that has listed some of the key takeaways, which include the aim to actually ramp up the cargo business and to expand their presence in Tier 2, Tier 3, Tier 4 cities as well. So, Amit, what is this latest update? What are the key highlights that we are getting in from this management takeaway?
Well, if you see, the SpiceJet management highlighted 3 focus areas for growth going forward. Firstly, is the fact that they are looking to ramp up their cargo business. Now, they're saying that post the recent spin-off of the cargo business, the company is targeting a significant scale-up in the cargo with induction of new aircraft. Now, the company has already signed the letter of intent for 10 aircraft with deliveries targeted in the next 16 to 18 months. And it aims to grow its cargo fleet to around 28 to 32 planes over the next 3 to 4 years as compared to 3 planes that the company has currently. Now, the second focus area would be expanding its presence in tier 2, tier 3 and tier 4 cities. Now historically, if you see, SpiceJet has been strong in connecting smaller towns via the participation in government's regional connectivity scheme, and they are saying that the smaller towns offer higher revenue and occupancy as per the management. So that's what their focus is going to be. And thirdly, they're also focusing on increasing their international presence. Now they're aiming to grow in international markets via code share agreements and strategic partnerships, and this will start reflecting by the end of financial year FY24, that is the current financial year, and they're aiming to increase the international mix in their total capacity to around 40% versus 20% that we are seeing currently. On the grounded fleet, they are saying that of the company's total fleet size, 25 aircraft are currently grounded owing to working capital and supply chain challenges, and SpiceJet management has recently raised loans that will be used as working capital and to unground this aircraft. Now the company aims to unground the grounded fleet over the next 6 to 12 months and may also procure aircraft under its long pending aircraft order that it had given to Boeing, that is a 150 MAX. So these are the key highlights coming in from the SpiceJet's management meet.
Right, thank you so much for that, Somit. But hang in there. There's another sector that you track very closely, and Tata Communication has indeed reported a set of weak numbers for the March quarter. Do break down these numbers for us, Somit. You have all the details. Take it away.
Well, Tata Communications reported a weak set of numbers in the fourth quarter of FY23. The big miss had come in on the margin front, where the margins came in at around 22.6% as against expectations of close to 23.9% by the analyst. Now, breaking down the numbers, if you see the data segment revenue was around 2.8% on a Q-on-Q basis, which was pretty much in line with what the street was expecting. But the big miss came in on the margin front, and that is because the data segment EBITDA declined nearly 7% on a Q-on-Q basis to around 882 crore rupees, and this was primarily on the back of employee costs that we had seen in the fourth quarter. Now, in fourth quarter, if you see, the company has added nearly 250 employees, and in the past 2 years, they have added close to 2,000 employees. Now, because of this 250 employee addition, the employee cost increased by around 30% on a Q-on-Q basis. Along with this, if you see, the depreciation cost also had a one-off of around 60 crore rupees due to some write-off, because of which the PAT also declined by around 17% on a Q-on-Q basis. However, on the positive side, if you see, the ramp-up in employee was in anticipation of revenue growth, which is clearly been seen in the data segment, and also the management is saying that the order wins has been pretty much strong despite the tough macro environment that we are seeing currently globally. Now, analysts also believe that the margin pressure is likely behind for Tata Communication, and this pressure was owing to employee costs, which is largely now behind for Tata Communication, and going forward they are expecting a sustainable revenue growth along with EBITDA growth. On the free cash flow front, if you see, they generated 630 crore of free cash flow. The capex was higher, around 530 crore, but due to higher free cash flow, the company's net debt came down by around 9% The board has also approved a dividend of 21 rupees per share as against 20.7 given by the company in the previous year. And in the notes to account, the company did mention some concern around the receivables from Vodafone Idea to the tune of close to 172 crore rupees, but that is just 10% of the annual profit, and the company believes that the balance is good and recoverable as there are ongoing interactions with Vodafone Idea.
Okay, thank you so much for that update coming in on Tata Communications on its numbers. Thank you so much for that, Somit. Let's move on. A tech major HCL Tech is set to report its Q4 numbers. How are they looking like? Is that going to be a weak set from HCL Tech as well? What is the street expecting? Let's go across to Anisha to get more details on that. Anisha?
Well, after a dismal set coming in from Infosys, the street is bracing itself for a bit of disappointment from the rest of the IT pack as well. And from HCL Tech, the expectations were as it is muted, because the guidance that the company had given for FY23 implied that there could be a decline to the tune of 1.5% to a flat number coming in as far as constant currency growth is concerned in Q4. And that's the reason the street is bracing itself for a revenue decline as far as dollar revenue is concerned to $3,220 million. And the rupee revenue is expected to stay around the 26,530 crore mark as well. The EBIT margin is likely to decline on a sequential basis, and quite a bit of decline there to the tune of 150 basis points. And that is because we have seen that the seasonality of the PNP business is expected to come into the picture, and that's the reason we'll see a margin decline as well. Profitability as a result of all of that is expected to slide by around 5%, and the constant currency growth rate is rather wide. There's the expectation that there could be a decline of 2% to all the way growth of 1%. So the street is really divided as far as that is concerned. The new deal pipeline might be a bit sluggish as well. So a decline of 5 to 10% on a year-on-year basis is something which is baked in. Going forward, the management commentary regarding FY24 will be the most crucial to watch out for, plus the commentary regarding ramp downs as well as cancellations, because that is what we heard from Infosys as well. And whether this slowdown that we saw from Infosys was a structural story, is it happening for all the companies, is there a broad-based slowdown, those kind of commentary will be keenly watched out for.
Well, with that, we're completely out of time on this one. Thank you so much for tuning in. Don't go anywhere. The market will take the action forward.